Hi, I'm Steve Breen with Prosperion Financial Advisors. Thank you for being a client and welcome to this Prosperion. There are millions of words written every day about the economy, the direction of financial markets, investment advice, on and on, yet no other topic gets as much attention as the concept of retirement. And when you think about it, it should get attention. You see, people spend their entire working career saving and planning for that phase of life. We prefer the phrase, making work a choice, yet we know many people struggle to understand the key issues around retirement. So today we want to cover three main areas: your plan, your longevity, and the impact of inflation. First, do you have a plan? You need to determine if you've accumulated enough capital during your working career to sustain you over a 30-year or more time horizon. Either you're planning for this or you are not. And if you're not, you better get a plan. Some surveys of Americans indicate some 80% of the population does not have a plan nor financial goals. Failing to plan is planning to fail. Now, estimating your income needs over a 30 or 40-year period is a challenge, which is why we invest in tools and research to help plan for the impact of inflation, rising healthcare expenses, and other uncertainties and needs. There are simply too many variables involved to rely on a back-of-the-napkin math, rules of thumb, or ballpark estimates. Clearly, this is one of the most important services that we provide to clients. Far more valuable than forecasting the economy, trying to be tactical, or guess which investments may or may not outperform over the next 6 or 12 months. Anyone can play the stock market guessing game. Professionals help you to work toward making sure your plan is solid and accommodates whatever challenges you may face. Second, how long are you going to live or planning to live? You need to consider your longevity and longevity of your money. In today's world, life expectancies for a non-smoking couple who retire at age 62 is over 30 years. On average, at least one of the two individuals will live to 92. That's just the average. With healthcare extending life expectancies, there's a good chance that you will live longer than you anticipate. Heck, we have clients that tell us about water polo tournaments at their independent living communities. Now picture that. Retirees can expect to live many more years than generations of yesteryear. This means your retirement savings will need to last longer than previous generations. Financially, there are really only two outcomes. Either your money outlasts you or you outlive your money. Now, for those water polo players, the ones that are intent on enjoying a full and active lifestyle, the degree of certainty that their capital and income will outlast them has to be a priority. And it is. The alternative is to watch people consume their income, deplete their capital, and still have several good years ahead of them. It's essential to realistically consider these two outcomes. Taking the time to understand the potential consequences of your actions today could have a large influence on the outcome tomorrow. Make smart choices while you still can. You know, it's really about investor behavior. Now, the third area is, does your plan account for inflation? Over a 30 or 40-year period, the impact of inflation on purchasing power could have a substantial difference on retirees' lives. Nearly every year, inflation, or the cost of goods and services, has risen. On average, the Consumer Price Index, or CPI, has been compounding around 3% per year over the last century. And I doubt if that's going to change significantly anytime soon. This simply means you could see your living costs rise by 2.5-fold during your retirement period. Let that number soak in. 2.5-fold. Well, investments that do not increase their income either from additional interest or dividends that are rising at a rate greater than the inflation rate, result in less purchasing power in the future. That's why fixed income can be risky for retirement cash flow. Fixed income means the income is fixed. It doesn't rise. Equity investments or stocks, especially those that pay rising dividends, are different from any other investment class. Stocks are the only one that capture human ingenuity, which I believe is the ultimate asset. Human ingenuity remains one of the most understated, underrated reasons for investing in the stock market's potential for growth over time. I believe ingenuity is an unfair advantage, and frankly, I want every single unfair advantage for clients. Conversely, I strongly believe that fixed income strategy may not sustain retirees through a 30 or 40-year retirement period, especially when you account for the rising costs of living or inflation. It's essential to consider these three principles, but especially number 3. Careful planning can shed light on the likelihood of exhausting your money or outliving your resources. If you'd like to have a conversation about these principles or discuss our investment philosophy and strategies, we welcome the opportunity. Likewise, if you know of someone who does not have clarity and confidence about their retirement, feel free to forward this video to them. We love helping clients have clarity and confidence about their resources and have great capability in their future. That's our why, and that's who we are. Thank you for being a client of Prosperion Financial Advisors. I'm Steve Breen.